Well, welcome everybody. This is the 17th day of June 2014, and this is the third of a three-part series on prohibited transactions for our SDRA Safeguard clients. Just to review what we've done before, on April 15th we had a session on what is a prohibited transaction and what are the consequences. On May 20th, we talked about what plan assets were and why that was important. And today we're going to talk about who or what is disqualified and wind up with some, what I call my top 10 mistakes. It sort of summarizes everything we've covered over the last 3 or 4 months. So just to review, a prohibited transaction is one of 6 types of transactions, and it's a transaction that has to be done either directly or indirectly. It has to involve property of the plan, also known as plan assets, and the plan can be an IRA or a solo K, and the transaction has to be between the plan and a disqualified person. So we're talking about disqualified persons today. So just some important definitions. A plan, of course, is any retirement plan, but it includes all SDRAs, self-directed retirement accounts. Plan assets are any assets that are owned by the plan, and that would mean your self-directed retirement accounts assets and investments. And a fiduciary. This is an important definition. Any person who has discretionary authority or control over the plan's assets, or manages the plan's assets, or provides investment advice, or manages or administers the plan, is a fiduciary. And as a self-directed retirement account owner, you are a fiduciary because you have discretionary authority or control over the assets and you manage them. And also, in many ways, you manage or administer your retirement account plan as well. So all self-directed retirement account owners are fiduciaries. So what are disqualified persons? Of course, that's the fiduciary, and so any self-directed retirement account owner is a disqualified person. You can't have transactions with your retirement account other than distributions, of course, and contributions. You can designate beneficiaries and a few other things, but nothing that would be a business transaction between yourself and your retirement account. Essentially, you're not supposed to have any benefit from your retirement account other than distributions on retirement. So then the second one is family members. All family members, as defined in the code, are disqualified persons as well. So that's your ancestors, which would mean your parents and grandparents. It would mean your spouse. It would be your lineal descendants, your children and grandchildren, and the spouses of your lineal descendants. It does not, however, include siblings. Why that is, I'm not quite sure, but I think that the policy behind that is that siblings generally do not have the same kind of support obligation that they would have for parents or children or spouses, and so they're kind of left off of the list of people who are in the family. There's a specific exception for that. So then we have something called, what I call 50% entities. These are entities that are owned 50% or more by the fiduciary. So any corporation that's owned directly or indirectly 50% or more by the fiduciary. And by that, we mean they own any stock that's either has all the voting power or has all the value of the corporation's assets. Next, any partnership of which 50% or more of the capital interests or profits are owned directly or indirectly by the fiduciary. So note that that's an or, 50% or more of the capital interests or profit interests are owned. So, but it doesn't refer to controlling interests. So in a partnership, you might have one person who's the controlling partner as to the day-to-day business affairs, and you might have limited partners who don't have control over the day-to-day affairs of the partnership, but it's the limited partnerships that own 50% or more of the capital interests or profit interests. And then finally, there are trusts, 50% or more for the benefit of a plan fiduciary. So once we get beyond that, Any officer or director of a 50% entity is also a disqualified person. So that would include managers of LLCs that are 50% or more owned by your retirement account, even if they're not you. And then there are 10% or more shareholders of 50% entities. So if there's a corporation that is owned 50% or more by the plan fiduciary, then any other shareholders that own 10% or more of the corporation are also disqualified persons. And that means that they can't have transactions with the retirement account. Then 10% or more partners in 50% entities. So in a partnership where 50% or more is owned by a disqualified person, like a fiduciary, then that partnership is also a disqualified person, as we have said before. But also the partners in that partnership are disqualified persons. So they can't have transactions with the retirement account of someone who is a 50% or more owner of the retirement of the entity. And then finally, there's highly compensated employees of 50% entities. So, and that would be an employee who owns 10% or more of the yearly wages of a 50% entity employer. So those are the highly paid people. So just to summarize, with 50% entities and the officers and directors and shareholders and highly compensated employees, it's the retirement account owner who is the owner of the entity, not the retirement account itself. So when the owner of the entity is, when the entity is owned 50% or more by the retirement account owner, then the entity itself is a disqualified person. So, okay, let's talk about ways to get, people might think of, to get around all this. So the easy question comes up, well, what if the entity is owned 50% or more by a corporation that I own? I don't directly own the entity 50% or more. Or what if it's owned by a trust that's got a trustee that's separate from me, and I'm a 50% beneficiary, but the trust is the owner and I am not, because that's not within those definitions we just talked about. Well, here's where we get into what are called the constructive ownership rules, which are incorporated in Section 4975, where the prohibited transaction rules are, from other sections of the code. So, and we also call these the attribution rules. In other words, your interest in the entity is attributed, the interest of someone else in the entity is attributed to you. So here's what the constructive ownership rules do. Essentially, any entity that can be considered to be owned by you when it is owned by another person or entity that has a specific kind of relationship with you. And if so, the entity will be a disqualified person with respect to your self-directed retirement account. So here's an example. This is the easy one. You own 50% or more of Company A. Company A owns 50% or more of Company B. In that case, Company B is a disqualified person with respect to your self-directed retirement account. Then, of course, there's family members, as we talked about before. So if your son or daughter owns 50% or more of a limited liability company or a corporation, the company is a disqualified person with respect to your retirement account. And note that that says other than siblings. So if your brother or sister owns 50% or more of a company, then it is not, by virtue of the fact that they own it, a self-directed, a disqualified person. Then there are trusts, of course, for your benefit. So let's say John and Jen are siblings, and their parents created a trust under which they are each 50% beneficiaries. In that case, the trust is a disqualified person with respect to both John's self-directed retirement account and Jen's self-directed retirement account. Then here's a more complicated one. This is entities that are owned by partners. So in this case, John, who's a self-directed retirement account owner, and Joe are partners individually. They're partners in a business. John owns 50% of the 60% of the partnership, and Joe owns 40% of the partnership. John, on the other hand, owns 40% of a corporation, that's Corporation B, and Joe owns 60% of B. You might think that since John owns only 40% of Corporation B, it would not be a disqualified person with respect to his retirement account. Well, unfortunately, that's not true, B, in that case, is a disqualified person with respect to John's self-directed retirement account because it is owned by a partnership in which John owns the controlling interest, or John and Joe own the controlling interest. Now, you might start thinking, well, if all of these attribution rules are followed to their conclusion, we can have people who are attributed to be, who are owners and ownership is attributed to them, and we can start going off and attributing to people who are relatives of them or entities that they own. But there's a specific provision in the code that says that that's not true. So, for example, in the prior example, if Joe's wife owns 60%, that's Joe's wife owns 60% of company C. And remember, Joe's wife would be a disqualified person with respect to Joe's retirement account. So company C in this position, in this example, would be a disqualified person with respect to Joe's retirement account. But company C is not a disqualified person with respect to John's self-directed retirement account just because Joe's wife owns it. So, Joe's wife is a family member of John. John is a disqualified person with respect to, of Joe. And Joe is a disqualified person with respect to John's retirement account. But it doesn't go to that second degree or level just because of the wife's relationship to Joe, who has a relationship to John. So here's where we get into the really kind of interesting part of the attribution rules, and that's called the Swanson case. So the Swanson case was decided in the late 90s, and let me just sort of explain what the situation was. Mr. Swanson had an entity that was an exporter. He owns a very large portion of it himself, I believe 100%. And at that time, and there may still be, for all I know, companies that could be the broker of exported property. So, and they had a special tax advantage, and they made a lot of profits. So Mr. Swanson decided that he was going to create his own DISC, D-I-S-C. That's what the acronym for it was. And so he created a separate corporation. He was the president and treasurer and clerk and sole director of the corporation, and had the corporation issue 100% of its stock to his IRA. And then the corporation started having transactions with Mr. Swanson's business. IRS looked at the issuance of the stock to Mr. Swanson's IRA and got all upset, saying, well, Mr. Swanson is the president, treasurer, clerk, and sole director, so the issuance of the stock in the corporation has to be a prohibited transaction. Of course, they ignored the fact that the corporation was actually doing business with Mr. Swanson's business. I guess they didn't have that much experience in prohibited transactions at the time. And so they brought this to the tax court. It was appealed to the tax court, and Mr. Swanson won. The tax court basically said there's nothing in the definitions of the Section 4975 that says that just because a corporation has a person who is a disqualified person with respect to the retirement account, just because a corporation has that person as a president, treasurer, clerk of corporation, or all of above, that doesn't make the corporation itself a disqualified person. It has to be owned by somebody who is a disqualified person. And so what they said was, if a corporation has no owners, it can't be a disqualified person. They felt so strongly about it, as a matter of fact, that they actually awarded Mr. Swanson his attorney's fees because they felt that the IRS's position was so untenable. There simply was no statutory basis for it. So Mr. Swanson got his attorney's fees paid as well. Now, the extension of that then is that, well, what if I want to make a co-investment with my retirement account? If I put 50% of the money in, or some portion of the money in, and my retirement account puts some portion of the money in, at what point is that a prohibited transaction? Well, let's say on day one, I put in $100 to the entity, and a week or so later, my retirement account puts in an amount of investment. Let's say it's another $100 or $500. At the point where my retirement account puts the money in, I am the owner of 100% of the entity. At least that's the way people tend to think about this. And so the subsequent investment by the retirement account is a prohibited transaction. And by the way, they say this even though the operating agreement says that both parties are going to make a contribution, and both parties, when they sign the operating agreement, have subscribed for and agreed to pay for the units that they are actually buying. So the theory of simultaneous funding says that if the IRA and the IRA owners actually put their money into the entity at the same time, since the entity does not have any owners before that moment, then the entity can't be a disqualified person, and so we can simultaneously fund the entity with the IRA money and money from a disqualified person, and that isn't a prohibited transaction. Now, that is not what the Swanson case held. That is the conclusion that many people have drawn as a matter of practice from the Swanson case. So here's the illustration. We have an LLC that owns a building or a home that's leasing out to somebody. Here's Phil, and here's Phil's custodian with his self-directed retirement account. So the self-directed custodian is going to contribute 50%, and Phil's going to contribute 50%, and they do it at the same time. That's simultaneous funding. So, you know, I don't particularly think that makes a lot of sense, but that is the conclusion that many people have drawn from the Swanson case. It is not what the Swanson case actually held, however. So then the Swanson case went a little bit further than it needed to go, and the tax court, in a footnote, and I think this footnote was probably written by a smart clerk, not really cognizant of how business works, but the footnote said that the day after Mr. Swanson's IRA put 100% of the funding into the entity was a disqualified person with respect to the retirement account. And here's how they got there. They said an IRA is a trust for the benefit of 50% or more, 50% or more for the benefit of its owner, meaning Mr. Swanson in this case. An IRA's owner is a fiduciary. A corporation owned more than 50% by an IRA, therefore, is a disqualified person with respect to the IRA. Huh? Does that make sense? Well, that's what the footnote says. So here's the implication. If an IRA owns 50% or more of an entity, additional contributions of capital are prohibited transactions, because that would be an exchange of plan assets between a plan and a disqualified person. So that is the source of the conclusion that people have drawn, called that there can be no follow-on investment. So does it also mean that the LLC can't distribute earnings to its IRA owner, even though there was one tranche of investment to begin with? That would be essentially the logical conclusion of the Swanson case footnote. So here's my take on it. An IRA is not actually a trust more than 50% for the benefit of its owner. Under the Internal Revenue Code, unless a term is defined within the code, we look to state law to determine what it means. And the term trust is not specifically defined in the code for these purposes, so we have to go to state law. And state law would normally say that a trust that has one beneficiary, and of which the trustee, meaning that in this case the custodian, is subject to the control of that beneficiary, it would not be a true trust. In Massachusetts, that's what we call a nominee trust, and it's not really a trust. What it is an agency relationship between the beneficiary and the so-called trustee. So in the case of a Pensco account, for example, the account agreement says that Pensco has no discretionary authority over the investment of your assets held in the account. The only person who has the discretion to do that is you, the account holder. And in fact, the account is really just like a bank account or a brokerage account. It just has certain special qualities. It's exempt from income tax for its earnings. You don't pay any tax on the contributions because you get to deduct them unless it's a Roth. And you only pay tax on the money when you take it out, but you can't take it out before you're 59 and a half. These are all provisions of the code that apply specifically to this type of account. But that does not make the account a trust. As a matter of fact, Section 408 that authorizes custodial accounts for IRAs specifically says that they are not trusts. So here's what it says, and this is Section 408H. Note the highlighted portions. For the purposes of Section 408, and that's the IRA authorization, a custodial account shall be treated as a trust, and that's a custodial account like your account at Pensco. If the assets in the account are held by a bank or qualified custodian. And two, if the custodial account would, except for the fact that it is not a trust, constitute an individual retirement account described in subsection A. Now, subsection A of Section 408 specifically lists the requirements for a trust that is going to be an individual retirement account to meet the qualifications of the special favorable tax treatment that they are given. And it essentially says that it's going to be treated the same as a qualified plan under Section 401, such as a 401k. So, and what they did in Section 408H is say, well, we might have situations where they're not specifically trusteed plans. We don't have a corporate trustee that's actually running the plan. We want to provide a method by which the individual retirement account owner can control the investment of their plan and make decisions on that basis, decide where it's going to be invested, etc. So they created what we call custodial accounts. And so Section 408H is where that is authorized. So, but it says, if the custodial account has the same provisions that would otherwise qualify it as an IRA under Section 408A, then it's going to be treated as a trust, even though it's not. So the custodial account would, except for the fact that it's not a trust, constitute an individual retirement account described in subsection A. So in other words, if it has all the provisions that qualified under subsection A, but it's not a trust, it's a custodial account with an approved custodian, then it's going to be treated like a trust. And then it says, of course, that the custodian, for all purposes of the section, is going to be treated as a trustee of the custodial account. And the reason for that is that the custodian of the IRA has a lot of requirements under the code as trustee to report ownership and report the value of trusts and distributions, etc., with your IRS. So they incorporate all of those provisions and apply them to custodial accounts in order to do that. And that's how custodial accounts become qualified. So you'll find that there are a bunch of different self-directed retirement account custodians, all of whom have applied to the Secretary of the IRS, to the IRS Commissioner, and been approved to be a person who can deal with all those reporting requirements and record keeping, etc. But again, it's premised on the fact that a custodial account is not actually a trust. So the Swanson case's conclusion that a custodial account is a trust is erroneous, both under the law in most states, and I don't know any states where it's not the law, and also under Section 408H. And this, of course, is there was recently another case that was decided by the tax court where they repeated the same language, and again, the decision of the court was not based on that assertion, and the assertion was not necessary to the finding or to the holding. So again, it's not precedent. It's just very troubling statements by the tax court that have really serious and silly implications for IRA investments. So hopefully that will be resolved over time. As a matter of fact, the Labor Department has actually made decisions completely opposite to that position. And what its position is that a qualified plan that invests additional money into an entity of which it owns 50% or more is not committing a prohibited transaction. In other words, follow-on investment is okay. So they decided this in an advisory opinion in 2003, and I have to tell you that advisory opinions by the Department of Labor are only binding with respect to the party that sought them. So we can't really say that this is a precedent that we can rely on unless we also get our own advisory opinion consistent with it. So what they decided was, and I'll give you a little history here. Mellon Bank is an investment bank. An investment, they provide investment advice for qualified plans. And Verizon had a bunch of qualified plans for its employees. And so they made an arrangement with Mellon Bank that Mellon Bank would be the trustee and become the, I'm not the trustee, but Mellon Bank would invest their money. So they created a limited partnership under which Mellon Bank was the general partner and in control of the assets, and allowed the various different Verizon plans to become investors in the partnership. The partnership then made investments in something called the CIV. I forget exactly at this moment what that stands for, but essentially it was a pool that the contributors could make investments in. And as it turned out, Mellon Bank was the major investor in this pool. The pool was actually run by somebody unrelated to Mellon Bank. I think it was a subsidiary of Verizon. But so Mellon Bank didn't actually run the pool, and the investments of money that was put into the pool was actually made by somebody else. So essentially, this is a mutual fund into which Mellon is making contributions or is making investments for and on behalf of its partners, which are qualified plans. So Mellon Bank said, well, what about the Swanson case? If I own 50% or more of the pool, the CIV, doesn't that mean that I'm going to be committing a prohibited transaction? Because now once I own 50% or more, if I make further investments in it, isn't that a prohibited transaction under the Swanson footnote? And by the way, I note that in the advisory opinion, Swanson isn't cited once by the Department of Labor, but that's the issue. And what they said was, and they decided this, by the way, they decided this case under ERISA, not under Section 4975, but the provision that Mellon was concerned about was Section 314G of ERISA, which is a particular code section in a different chapter of the code, but it parallels exactly the provisions that are in Section 4975 with regard to who is a disqualified person. Remember, that's the 50% or more entity. So the 50% or more entity rule also applies to qualified plans, to which the Labor Department provisions of I think it's Title 29 applies. So we have the exact same code. The terms of this code provision is exactly the same as Section 4975, and of course Mellon was concerned about the same issue. And so what the Department of Labor said was, well, a plan's ownership of 50% or more of a partnership entity will not cause that partnership to become a party in interest with respect to that investing plan. And the term party in interest is the same as a disqualified person. So the partnership doesn't become a disqualified person just because of the investment of 50%. So although Mellon would hold more than 50% of the value of the CIV interests, it would hold such interests on behalf of the Verizon plans, not on behalf of itself or a third party. So, you know, how does that differ from the investment by an IRA, for example, in Mr. Swanson's case? Well, of course, the IRA holds the investment on behalf of itself, and itself is for the benefit of Mr. Swanson, but it isn't holding it like a third party for Mr. Swanson to have a benefit during his lifetime. So it doesn't make a whole lot of sense for Mellon to have a ruling that says, okay, it's okay for you to continue to make investments 50% or more, but it's not for an IRA. This would be an extraordinarily inconsistent interpretation of both provisions. They are exactly the same. So my take on it is that the tax court's footnote is wrong. All right, so the Swanson case actually is the basis for simultaneous investment theory, and that's what I call SIT or SIT. And you can read these on my blog on the website, heritagedesignlawgroup.com. And it's also the basis of the theory of no follow investment is allowed. That's no fit, my term for it. The Department of Labor says follow-on investment is okay, even though a qualified trust owns 50% or more, or a retirement account owns 50% or more. And Pensko is therefore put into a kind of awkward position. It's essentially determined that if an IRA owns 100% of an entity, all it's doing when it's putting more money in is making an investment in its own investment, which is basically the Department of Labor's position. But because of the inconsistency between the case, which is the only court precedent or statement that we have, Pensko essentially takes the position that follow-on investment is not okay with entities where the IRA owns 50% or more but less than 100%. So an IRA can own 98% of an entity and it can't put more money in as far as Pensko is concerned. And now I will say that this is really not Pensko's fault. They're sort of put into this position because of the way the various different cases are written. And if you're counsel for them, you have to sort of advise them to be conservative. It seems fairly certain from the Labor Department's positions that they've taken that it's certainly okay for an IRA or for a qualified plan to invest add more money to the same investment that it already holds. So if you own 100%, if you own a stock in a company, regardless of the percentage of ownership, you ought to be able to invest more money in that company. So that's the issue. That's really the fundamental problem right now in the issue of who owns what, and that's the Swanson case. And essentially what it says is we always have to be concerned that an IRA will be considered to be a trust, and therefore its investments make the entity, if it's owned 50% or more, become a disqualified person with respect to itself. And, you know, again, it has never made sense to me that an IRA could end up making an investment in which the investment is a disqualified person with respect to itself, if it's the controlling investor. So let's talk about my top 10 mistakes that I've seen people make. And I'm going to take them from the most common to the most complicated, but let's start with this one. The first one is what I call pulling the trigger too soon. And I see this often, particularly in real estate transactions. Here, Phil, he's our IRA owner, and this is the subject of most of these slides are the subject of his investment. So he wants to invest in a house for investment, and so he hires a broker, and he has the sellers, and we're going to have the closing, and he signs a purchase and sale agreement with the sellers. And so in order to bind the property, he gives a deposit to the broker, and the broker holds the deposit under the purchase and sale agreement. And at this point, Phil has not involved his retirement account at all. So he signed the purchase and sale agreement. He put the deposit in from his own money that was not retirement account money. Then he goes to his retirement account and he instructs the retirement account custodian, that would be your Pensko, to purchase the property. So Pensko actually pays the money directly to the sellers through the closing attorney. And the broker then takes the money that it holds as the deposit and also pays it to the seller. Well, this is a problem because now we have Phil's personal money that's not retirement account money being invested in the property that is now being held by the retirement account. And that doesn't work. So essentially what that involves is an excess contribution at the least, and also potentially a prohibited transaction, because it's the transfer of money between Phil and his retirement account other than as a qualified contribution. So let's try this. So what Phil does is he says, okay, I'm going to start right at the beginning. I'm going to tell Pensco, sign a purchase and sale agreement with the sellers, and that'll start it. And then Pensco, the agreement that we had before is void now. So we do this at the closing. This can be done at the closing, but normally you ought to do this up front. So now Pensco pays the money to the seller in full, 100%. And the seller then pays the broker. So the broker gets its brokerage fee from the seller. And in this case then, Phil's deposit goes back to Phil. And people have done this at closing. Now, if you have a cooperative seller, and the seller agrees, okay, I'll sign a new purchase and sale agreement that says that the buyer is Pensco, and I'll take all the money from Pensco, and you can persuade the closing attorney to not commingle the deposit amounts that are received in escrow pending the closing, and not commingle those with the money that's going to the seller, then that's fine, and people have done that a lot. I'm not sure it makes a whole lot of sense to do it that way, but it seems like it's a way to work around the premature pulling the trigger too soon and the excess contribution problem. So then we have problems with managing the property. Here's Phil has this property. His retirement account owns the property now. What can Phil do? Can he decide on lease terms? There's a bunch of things we want to know. Can he prepare the lease document himself? Can he receive rent checks? Can he send checks to the custodian? Can he collect the rents? These are all things Phil's going to have to do because Pensco and any other custodian isn't going to do it for him. They're not a trustee. They're not going to have direct relationships with the tenants. They're just going to do what Phil says. So, and then can he sweep the floors? Or can he fix the toilets? Because, you know, there's lots of things that come up. Well, these are services that are either fiduciary services, and Phil can provide services to his retirement plan as a fiduciary as long as they're what are called settlor services. There are services that are necessary for the establishment or administration of the plan itself, but not otherwise. So if he's not doing non-fiduciary, if he's doing non-fiduciary services, his services are prohibited transactions because you can't provide services to your retirement account, with that one exception. So let's test these here. So it seems okay for Phil to decide what the lease terms are going to be, because he's basically deciding how the money in the fund is going to be invested and what the terms are going to be with the tenant. But can he prepare the lease document? Probably not. That would be something that he would hire an attorney for. Can he receive the rent checks? Well, yes, that's necessary for administering the plan, and he should send them to the custodian. Now, as a side note, Phil should not establish a separate account under his control that he has the deposit checks made to. The tenant has to be instructed to make the check payable to Pensco as custodian for Phil's account, and they can send a check to Phil. If Phil can't deposit the check, he has to forward them on to Pensco. So, but can he collect the rents? Well, he's received the check that's collecting the rents, but if he has to go out and actually take action to collect a defaulting rental, like going to court or something like that, that would be services to his plan. That would not be something that a trustee or fiduciary would normally do, and so he has to hire somebody to do that himself. Certainly he can't sweep the floors, and he can't fix the toilet. Now this is, if you've read the story of the generous mistake that I sent you as part of your SDRAFocus Safeguard materials to begin with, that's what happened to the Phil in that case. So, the problem here is that if Phil does any of these things that are not allowed, you know, up front nobody's going to really know about it. But later on, if he gets audited a few years later, IRS is going to say, and discovers it, IRS is going to say that his retirement account has been disqualified as of the date that he did those things, as of January 1st of the year in which he did those things. And so he owes income taxes for the year when his retirement account was disqualified based on the value in the account. And then he owes income taxes on the earnings on the account since that time, plus penalties and interest for underreporting his income, et cetera, et cetera. It can snowball. You can end up with owing more money than was in your retirement plan. What's worse is that if Phil actually gets into financial difficulties and his retirement account is not exempt from claims for state is exempt from claims, his creditor might start examining what he did for his retirement account and try to disqualify the retirement account then and then collect the money. This is a strategy that bankruptcy trustees seem to be following a lot now. They're seeing somebody with a self-directed retirement account, going back over as many years as they can do to see if they can find a prohibited transaction between the owner and his retirement account, so they can make the assets in the retirement account subject to claims in the bankruptcy. So these are problems that Phil would have, and even if he does them, he gets away with it. A few years later, it can end up really snowballing and biting him. So what Phil should do is to hire a manager to do those things that Phil should not do. And so the manager can actually decide the lease terms based on Phil's instructions, prepare the lease document, receive and send the rent checks to the custodian, get the floors swept and fix the toilets. And as long as the property manager is not a disqualified person, him or herself, then Phil's clear. And it's easy for Phil at that point, years later, to say, oh no, I didn't do any of that stuff. I hired a property manager. He did all that stuff. And so, I got away free and clear. I was prepared. All right, so then we have another problem. In this case, and that's the problem of undercapitalization. In this case, Phil's house has now been flooded. There's been torrential rains, a hurricane, wherever it is, and the house has been completely flooded, and it's been damaged severely, and he needs to fix it. So, what can Phil do? Can he pay his expenses from his non-self-directed retirement account funds? Because, the retirement account really just owns the property. It purchased it. It doesn't necessarily have any funds in it except for the property. So can he pay the expenses from his non-self-directed retirement account funds? Well, that's one question, and the answer to that, of course, is no, because that would be, just like before, an excess contribution. Can he guarantee a loan from a bank? So we're going to borrow money to do that from a bank? Well, no, that, again, would be a prohibited transaction because it's a credit arrangement between Phil and his retirement account. What about adding more funds from his retirement account to a self-directed retirement account? So he has another account, let's say at Fidelity, and he says, okay, I'm going to transfer money to my retirement account so it can pay the new expenses to repair the property. That would be fine. And can he lend money to a self-directed retirement account on an emergency basis? Well, the code specifically says you can't loan money to your retirement account, but the Labor Department has come out with some exemptions because they are actually in the code that the Labor Department can, on an advanced basis, make interpretations of Section 4975, and they've come out with some exemptions that allow emergency loans to take care of emergencies for retirement account plans. So if there's an emergency, then Phil may be able to do it. The problem with those Labor Department regulations is that they are very new, they're untested, and if you really want to use it, you really should get an advisory opinion from the Labor Department to see if you fit within its exceptions. So again, that may be okay. So what about this? If the IRA, if his sister has money that he or she can lend, to Phil's retirement account, can the IRA borrow the money from her? And that, of course, is okay because she is not a disqualified person with respect to his retirement account. But again, this is a problem of undercapitalization. We've got to go looking. If we don't have enough money in the retirement account to take care of emergencies, where are we going to go? So the real question then is, okay, suppose that the tenant also was injured in the flood. Now, the tenant has a claim against the retirement account, but also because Phil is its fiduciary and has been interacting with the tenant and involved in the transaction, and because one could argue that the account is really just a bank account or a brokerage account for Phil, Phil is liable too. So the tenant could argue that Phil is liable. And in that case, Phil could lose the retirement account to the tenant's claims and still have obligations to the tenant from his own money. So then the question is, did Phil instruct the custodian to buy liability insurance, which of course he should have. So what this really illustrates is the next mistake, which is what I call the wrong holding entity mistake. So here's the way this should go. Phil establishes an LLC that purchases the property. The custodian owns the LLC, and the tenant's agreements are between the LLC that's owned by the custodian. And Phil has his property manager dealing with the tenant and not himself, of course. So that way he's not intimately involved in any negligence that might have occurred. And so now we've gotten rid of that problem. And this, of course, is the configuration of all single-member LLCs in which Pensco is the custodian. You know, most of our clients who are managers of their LLCs realize that when they're actually managing personal property, real estate, they should get a property manager and account for that before they actually make the investment in deciding, you know, what the returns are going to be. Account for the fact that you've got to pay a manager and you're going to have a net cash flow. So now we got rid of the wrong holding entity problem. So what's the next one? Well, okay, we have the simultaneous investment issue. So Phil would like to invest money with his retirement account in the LLC to buy them both. So the IRA makes an investment of 50%. Phil makes an investment of 50%. And now the IRA and Phil own the property 50-50. Well, so now we have the disaster. What happens? Well, where do we get the money? Can the IRA add more capital? Well, no, it can't, because the LLC is 50% or more owned by Phil, who is a disqualified person with respect to the retirement account. So that's out. So essentially this is the mistake of the wrong partner. Can Phil add more capital? Well, that is a very strong maybe. The problem here is that we don't really know whether the transfer of additional money to the LLC is going to be considered a loan to the retirement account, because the retirement account can't put more money in. And so oftentimes when we've seen this kind of situation, we've tried to account for it with the provisions that say it's going to adjust the ownership of the LLC when that occurs. Then you have all kinds of problems with, well, is this a fiduciary taking advantage of the retirement account? Phil's a fiduciary. Has he violated his fiduciary duties to the retirement account? There's all kinds of ins and outs that might cloud that whole decision. So, you know, that's a problem. So now let's say that we own the property. The other problem we have here is, remember I said Phil wanted to buy the property with his retirement account. Well, why did he do that? Is that because he couldn't afford to buy the property by himself? Well, under the code, there's a provision that says that if Phil could be actually getting an indirect personal benefit. This is sometimes referred to as the prior arrangement. He's having his retirement account make an investment in the LLC in a way that means that he himself is able to afford the investment in the LLC. So he's getting an indirect personal benefit from his retirement account. And so we call that the indirect personal benefits problem. So usually when we have co-investment going on, I will ask the Phil involved, can you buy the property 100% by yourself or with your own resources? Now, if the answer is no, I can't do it, then that's probably a prohibited transaction regardless of whether we have simultaneous funding or not. And so this whole arrangement of simultaneous funding and of co-ownership, there are lots of different minefields that we have to walk through in order to do that. So let's say then that Phil's brother, Paul, is going to be the 50% investor in the LLC. So now Phil is not directly personally investor. His custodian, his retirement account, is the 50% investor. So can the IRA add more capital? Well, that would be a yes. But wait a second. Remember we said the IRA could be considered a disqualified person with respect to itself. And in this case, Phil's retirement account owns 50% of the entity. This is what I call the 50% trap. We don't really know if it's a trap. We don't know if the tax code is correct, but it's a problem. We don't know if the IRA can add more capital. So, now Phil's brother, Paul, could be a little bit upset when we end up with some kind of a disaster or problem with the property. So here's another one. Here is a much more advantageous configuration where Phil's IRA owns 1/3 of the LLC, Paul owns 1/3 of the LLC, and their friend, unrelated, or maybe sibling of Phil, Mary, owns 1/3. All right. So in this case, we have a situation where the IRA could make additional investments because it doesn't own 50% or more. Neither Paul nor Mary is a disqualified person, so PPM is not a disqualified person. So the custodian has no problem with making additional investments to it for capital improvements, to take care of various different disasters, etc. There's no problem with that. What about if we don't have, nobody has enough money and we want to make some renovations to the property? Can PPM borrow money to renovate the property? Well, the answer to that is yes. We go to a bank, we make the contribution, and the bank makes the loan. So we get the loan to do that. But, and let's say that's 60% of the equity of the property. Well, here we have what's called surprise UBIT, unrelated business income tax. A lot of people think that if they don't actually buy the property with bank funds, with a loan, it's not an acquisition loan, that they don't have an unrelated business income tax problem. Because remember, when you have debt financing on a piece of property, that could be unrelated business taxable income that comes out of it. But the code actually says that if the loan from the bank was reasonably anticipated when you purchased the property, it's still acquisition financing. So if you bought the property for cash and planned to make renovations with a bank loan, that's still acquisition financing, and so you could end up with surprise unrelated business taxable income for Phil's custodian, for Phil's retirement account. So Phil has to actually run the numbers to see, okay, if we're going to have a 50% loan, 60% of my share of the profits is going to be taxable to my retirement account, and I've got to be aware of that every year so that I report what PPM provided me with profits in terms of the property, and pay tax on 60% of that income, subject to the exemption, $1,000 exemption. But suppose Phil's retirement account is a solo K. A solo K is a qualified retirement plan that's actually allowed under Section 401 of the code. It is not an IRA. And interestingly enough, the solo K does not have the same problem that an IRA does. Qualified plans can borrow money for acquisition purposes without having unrelated business taxable income. So if Phil's retirement account, his SDRA, is a solo K, we don't have surprise UBIT. So next question is, well, all right, Phil and Paul and Mary are going to the bank and borrowing the money. Paul and Mary are probably going to be asked to guarantee the loan because most banks don't do non-recourse financing where nobody guarantees the loan. It's only PPM that is signing the note, and the only remedy that the bank has is to take the property if there's a default. So let's say that Paul and Mary say to Phil, okay, we'll do this whole deal, but we want you to guarantee the loan with the bank. Well, that's a problem too, because now Phil is making a credit arrangement indirectly with his solo K or his IRA, and that would be a prohibited transaction as well. So that's out. So before we're going to make this investment, 1/3, 1/3, 1/3, and we're going to use bank financing to get the loan, to get the rest of the equity, we have to be aware that this has to be non-recourse financing, and we have to make some kind of a special deal with the bank. There are some banks that do that for triple deckers. They have that down, but many banks don't want to do it because they're concerned about the debt-to-equity ratio. It needs to be lower than normally. Normally you might have 80%, so that debt-to-equity ratio is going to be lower. They have to do the same kind of underwriting, they have the same costs in determining whether to make the loan, but the profits aren't the same. So many banks don't like to do non-recourse financing for that reason. So now let's say we have the problem of managing the property. Now, the property that's owned by Mary, Paul, and Phil's custodian's IRA. We want to know, well, can Phil be the manager of the property? Well, yeah, Phil could be the manager of the property provided that he limits his services to fiduciary services like we talked about before, those settler services. Okay, but no, that is not something that Phil can do for pay. There is an exemption that is allowed under Section 4975 that allows Phil to provide those types of services without compensation. In other words, the services that are necessary for the administration or establishment of the plan, but Phil can't provide other services such as leasing and managing the property, doing all that other stuff. That would be a problem. So as the manager of your single member LLC, there are things that you can do, but you need to hire a manager to do that. So Phil can't be paid. And that points up the whole problem of failing to maintain compliance. It's really easy for many people, as I've told each one of you before, to become involved in self-directed retirement account investing, but it's also really easy without intentionally doing it to run afoul of the rules and then discover that you've done that later on when it's extraordinarily expensive to get out of the problem. So let's have a summary. The first thing I would say is that if it seems like it's an indirect prohibited transaction, it probably is. You know, there is no definition in the code of direct or indirect. I've made the interpretation on several occasions that I think the word indirect means that you've done something in order to circumvent what you couldn't otherwise do, and you did it intentionally. There are some cases that say intention is not necessary, but the problem that we have is how do you define indirect? Every transaction is indirectly related to other transactions, no matter who does them, in some degree. There's the butterfly effect, as you might say, in physics. So we have the problem of what is indirect in terms of a transaction with your retirement account. And in that likelihood, don't forget the prior arrangement rule. It may be possible to have your retirement account, the company that your retirement account is invested, actually hire you if the issue comes up later and it wasn't done by prior arrangement. There are some fairly complex ways that can be done based on Labor Department rules as to what are planned assets and who controls the entity. But if it was done with a prior arrangement, it probably won't work anyway, even if it would otherwise work. Also, you know, keep it simple. Avoid all those gray areas. That's why I'm telling you about the gray areas. These are the things that you should try to avoid. Invest with unrelated third parties. Try to avoid investing with yourself and with your family members. Again, it's probably less risky if unrelated third parties think it's a good investment too, and they keep you away from all those prohibited transaction problems. Be aware that all income is unrelated business taxable income unless it's exempt. So, and there's only certain exemptions. Rents are an exemption, interest is an exemption. Those are the primary exemptions that people rely on when they make real estate investments. Also, the profits that you realize on property held for investment is exempt from unrelated business income tax. But there's lots of other things. So if you invest in a widget manufacturer, that income, if it comes through to you as a partner, can end up being taxable income. Unless it's a corporation, you get it as a dividend. Dividends are exempt. That's how you get to invest in securities. If debt financing is in order, be aware of the unrelated debt financing issue that you may run up against, and run the numbers to see whether, even if you are paying the tax, the after-tax profits is worth the investment. And of course, be aware that you shouldn't guarantee any loans that are going to entities that your retirement account is investing in. Remember that your your self-directed retirement account single-member LLC assets are plan assets. Remember, the plan asset rules say that an investment in a real estate company, a real estate investment company, could mean that the assets of the LLC are not plan assets, so transactions with them are not prohibited transactions. But there is the 100% exception to that, and that's the exception that you have your single-member LLC under. Actually, that exception applies to every single-member LLC. So your plan assets, your assets that are inside your self-directed retirement accounts LLC are also plan assets. So anytime you have a dealing with that LLC, you are dealing directly with your plan. And remember, of course, in that respect, that you are a fiduciary, which means that anything you do can end up caught with your plan, can end up being a prohibited transaction, other than making contributions, designated beneficiaries, deciding where it's going to invest, and taking distributions when you're old enough and when you can do that. And then finally, my primary recommendation is that make your first call to Heritage Design Law Group when you're considering any transaction involving your self-directed retirement account. That's what the first call program is for. It's so that you can understand, and we can keep you clear of those gray areas, and we can answer the questions as easily and quickly as we can. Most people get into problems like the one that we described with Phil because they don't want to call somebody because it's going to cost them extra money. That, again, is what the SDRA Safeguard Program is for, so that we can answer your questions as long as there's not a major project when you want to call us. So that's our summary. Now what I'd like to do is just ask if anybody has any questions. If there aren't any questions, we're gonna finish this up.
I have one quick one, Frank.
Sure.
Right? Michael.
Yes, go ahead.
I picked up a recent Supreme Court case, Clark versus Rameker, R-A-M-E-K-E-R, decided June 12th. It essentially deals with inherited IRAs and their non-exemption under the bankruptcy code. I'm curious as to, well, first of all, you probably haven't even seen it, it's hot off the press, but curious as to whether or not the self-directed IRAs are going to begin to be affected by this type of thinking, and it might be something that I want to take a peek at and maybe give us your thoughts next webinar.
Well, sure, and I will tell you that an inherited IRA is exactly the same thing as the IRA that the original self-directed retirement account owner had. It has all the same restrictions, all the same problems, and also all of the same advantages of investing privately. So just because the self-directed retirement account owner died and the ownership or the benefit of the property went on to other beneficiaries doesn't mean that we don't also have the same prohibited transaction problems. All the prohibited transaction rules, including the ones in Section 408, include the beneficiaries. Now, Section 4975 does not define a beneficiary of a retirement account as a disqualified person per se. It's not in those definitions. And so one might say, well, okay, if it's just the beneficiary of the retirement account, then the prohibited transactions don't apply. Problem is that for an inherited IRA, the beneficiary does, for purposes of the self-directed retirement account, become the fiduciary of the plan. So they have the same position that the original owner had. If the retirement account is designated as if the beneficiary of the retirement account is designated as a trust, then it may be that the trustee is in control of those decisions, so we might not have problems, some of the problems. But still, if the trust is 50% or more for the benefit of the beneficiary, it could be a problem. And then Section 408 essentially incorporates Section 4975. There's some problems with the issue that people have interpreting Section 408. It essentially says that when a beneficiary or an owner of a retirement account conducts a transaction that is similar to or the same as that would be a prohibited transaction under Section 4975, the retirement account is disqualified. And so there is a lot of debate about whether that simply incorporates Section 4975 in Section 408, or whether it essentially creates a new type of disqualified person for a retirement account. But those are the issues that are currently outstanding, and it's possible, and I haven't read this case, but it's possible that case actually talks about those things. Would that be correct? Mike?
Yeah, what happens is that this came up in the bankruptcy context, but when you read the case, there's a whole discussion on inherited IRAs and how they should be treated differently. And I was concerned that maybe that some of the language in here may eventually get extended to self-directed IRAs. Just some food for thought there next time around.
Next time around, we'll make it a topic of one of our sessions. Thanks very much for pointing it out.
I'll email the case to you.
All right, thanks. Well, if there are no further questions, I guess we're done. And remember that there will be no sessions this summer, but in July and August. We take up again in September. The education classes are 10 months out of the year, so remember that there won't be any sessions in July and August. We will be sending you notice of the sessions in September and start up again with next year's curriculum. So thank you very much, everyone, and I wish you a happy summer and a good vacations.